Interest rates feel like background noise. A number on the news ticker. Up a little, down a little. Supposedly boring. But that number quietly decides who gets rewarded and who gets squeezed. Here's the uncomfortable truth. Interest rates aren't just about controlling inflation. They're about controlling behavior. And nobody explains that in school. Right now, interest rates matter more than they have in decades. Mortgages doubled. Businesses froze hiring. Governments suddenly looked nervous. And everyone was told the same simple story. Rates are high to fight inflation. That story is incomplete. To understand the real game, you have to zoom out. For most of modern history, money was expensive. Borrowing was risky. Debt had consequences. Then something changed. After the early 2000s, and especially after 2008, interest rates collapsed. Not to zero once, but again, and again, and again. Each time there was a crisis, rates went lower and stayed there longer. Low interest rates do one thing extremely well. They make borrowing feel painless. When money is cheap, people take more risks. Companies borrow to expand. Investors borrow to speculate. Governments borrow to delay hard decisions. That's the first layer of the game. But here's the part nobody spells out. Low rates don't affect everyone equally. If you already own assets, houses, stocks, businesses, low rates are a gift. Your assets rise in value because future money is discounted less. Everything looks more valuable when money costs almost nothing. If you don't own assets, low rates don't help nearly as much. Your wages don't rise automatically. Your savings earn nothing. And prices quietly adjust upward. Same interest rate. Very different outcomes. That's not a bug. It's math. Now flip the situation. When inflation starts rising, central banks raise rates. This is where the official story kicks in. Higher rates make borrowing expensive. Spending slows. Prices cool. But again, that's only part of what's happening. High interest rates apply pressure selectively. Households with debt feel it first. Businesses dependent on loans feel it next. Governments feel it last, but the hardest. Because governments are addicted to low rates. Years of cheap money allowed massive debt to build quietly. When rates rise, that debt suddenly becomes expensive. Every percentage point matters. Raise rates too little, inflation stays. Raise them too much, something breaks. And historically, something always breaks. That's the hidden mechanism. They're a timing device. Every cycle trains people to depend on cheap money. Every rescue reinforces risk-taking. Every hike reminds everyone who actually pays for stability. The system doesn't collapse because of interest rates. It survives because of them, but at a cost. So the next time you hear about a rate cut or a rate hike, don't ask whether it's good or bad. Ask a better question. Who does this help right now? And who is being asked to wait?